What if the biggest financial experiment of the decade just hit a wall? Not a small dip, not a healthy correction, a full-blown crash that wiped out over $2 trillion in market value, sent Bitcoin plummeting nearly 50%, and left millions of investors staring at their screens, wondering what just happened. If you've seen the headlines about Bitcoin crashing in February 2026, this is the full story. How we got here, what actually caused it, who got hurt, and what it means for the future of crypto. Because this crash didn't come out of nowhere. It was the result of greed, leverage, broken promises, a hedge fund blow up on the other side of the world, and one of the most dramatic reversals in financial history. By the end of this video, you'll understand everything. Let's start from the beginning. To understand why Bitcoin crashed, you have to understand why it was so high in the first place. Rewind to January 2024. The SEC finally approved spot Bitcoin ETFs after years of rejections. This was the moment the crypto world had been waiting for. For the first time, regular investors could buy Bitcoin through their normal brokerage accounts, wrapped in a familiar product. No crypto wallets, no exchanges, no seed phrases. Just click buy, like a stock. And buy they did. BlackRock's iShares Bitcoin Trust, ticker IBIT, became one of the fastest growing ETFs in history. Fidelity's FBTC followed closely behind. Within months, tens of billions of dollars poured in. By the end of 2024, Bitcoin had more than doubled, blowing past the $100,000 mark for the first time in December. The total crypto market ballooned to roughly $3.5 trillion. But the ETFs didn't just bring retail investors. They brought Wall Street, hedge funds, pension allocators, institutional money. By the fourth quarter of 2024, professional investors with over $100 million under management held $27 billion in Bitcoin ETFs. That was a 114% increase from just the prior quarter. Hedge funds alone accounted for 41% of all institutional Bitcoin ETF positions. Millennium Management was the single largest holder at $2.6 billion. Bitcoin wasn't a fringe asset anymore. It had a seat at the table. And that changed everything, in ways nobody fully appreciated at the time. Now layer in the politics. Donald Trump won the 2024 presidential election on a platform that included, among many other things, making America the crypto capital of the world. He promised a strategic Bitcoin reserve. He appointed crypto-friendly regulators. The industry was euphoric. In January 2025, Trump signed an executive order establishing a working group to explore a national digital asset stockpile. In March, he signed a more specific order for a strategic Bitcoin reserve, funded through Bitcoin seized in law enforcement operations. But here's the thing, the fine print disappointed people. The language was cautious. It talked about the potential creation of a stockpile. It referred broadly to digital assets, rather than committing specifically to Bitcoin. When the March order was signed, Bitcoin actually fell nearly 6%. Still, the broader trajectory was up. The political winds were favorable. Institutional money kept flowing. And by October 2025, Bitcoin hit an all-time high of $126,000. Think about that number for a second. $126,000 for a single Bitcoin, an asset that was worth less than a penny in 2009. That was trading at $3,000 during the 2018 bear market that people said was dead, over and over again. Several forces converged to push Bitcoin to that peak. The Federal Reserve had cut interest rates by 25 basis points in September 2025 and signaled more easing to come. That triggered what traders call the debasement trade, a bet that the dollar would weaken and hard assets would rise. Gold rallied. Bitcoin rallied harder. Spot Bitcoin ETFs had accumulated over $110 billion in assets under management. On a single day, October 7th, ETF inflows hit $1.2 billion. 8 consecutive days of positive flows. The demand was relentless. On-chain data from Glassnode showed 97% of all Bitcoin in circulation was in profit. 97%. That's not a healthy market. That's a market where almost everyone is a winner. And when almost everyone is a winner, it means almost everyone has something to lose. This is where the story turns. After the October peak, things started to unravel. Slowly at first, then all at once. In late October 2025, the Trump administration announced 100% tariffs on Chinese imports. The crypto market shed nearly $400 billion in 24 hours. Bitcoin started sliding. November 2025 was the worst month for crypto since 2022, with Bitcoin dropping 25%. But the decline didn't stop there. It ground lower through December. Then January. The air was coming out, and the mood was shifting. Deutsche Bank analysts noted that traditional investors were losing interest, and pessimism about crypto was growing. Then came the Kevin Warsh bombshell. In late January 2026, President Trump nominated Kevin Warsh to replace Jerome Powell as Federal Reserve Chair. Warsh is a former Fed governor with a reputation for hawkishness. He prioritizes monetary discipline. He's skeptical of loose monetary policy. He's talked about shrinking the Fed's balance sheet and curbing quantitative easing. For crypto, this was terrible news. Bitcoin and the broader crypto market thrive on cheap money and low interest rates. When the Fed is loose, investors reach for riskier assets. When the Fed tightens, they pull back. Warsh's nomination was a signal that the era of easy money, which had fueled so much of the crypto rally, might be ending. Bitcoin dropped below $70,000 on the news. But the worst was still ahead. February 5th, 2026. That's the day the floor fell out. Bitcoin plunged nearly $15,000 in 24 hours. The worst single-day crash since the FTX collapse in November 2022. At its lowest point, Bitcoin briefly touched $60,000, a level it hadn't seen since October 2024. In the span of 4 months, Bitcoin had lost nearly half its value. But here's what made this crash different from a normal sell-off. The selling pressure didn't come primarily from panicking retail traders on Coinbase or Binance. It came from something far more complex and far more dangerous. It came from Hong Kong. According to analysts and investigators, the crash was likely triggered by the collapse of several Hong Kong-based hedge funds that had built enormous, highly leveraged positions tied to Bitcoin ETFs. Specifically, BlackRock's IBIT. Here's what they did. These funds used a strategy called the yen carry trade. They borrowed money in Japanese yen, which had extremely low interest rates, and used that cheap financing to buy aggressive, out-of-the-money call options on IBIT. Essentially, they were making a massive leveraged bet that Bitcoin would keep going up. When Bitcoin was rising, this trade was printing money. But when Bitcoin started falling after the October peak, the trade turned against them. Their options lost value. The cost of their yen financing increased. And to make things worse, they also had exposure to turmoil in the silver market, which was convulsing at the same time. It was a perfect storm. Their positions deteriorated from every direction simultaneously, and when the losses became too large, they were forced to liquidate. massive, forced selling of IBIT shares, which drove Bitcoin down further, which triggered more liquidations, which drove it down even more. This is what traders call a cascade, or a liquidation spiral. Once it starts, it feeds on itself. The evidence was everywhere. Options trading on IBIT surged to a record 2.33 million contracts during the crash. The ETF posted $10 billion in trading volume on the single worst day. $10 billion for one. That's not normal trading. That's a fire sale. And here's the detail that confirmed the theory. Liquidations on centralized crypto exchanges were actually relatively muted compared to what you'd expect in a crash this severe. That told analysts the stress wasn't coming from the usual suspects. Futures traders and leveraged crypto degens. It was coming from traditional finance, from large IBIT holders, from hedge funds that had wrapped their Bitcoin bets in Wall Street's infrastructure. The very thing that was supposed to make Bitcoin safer and more legitimate, the ETFs, had become the vector for one of its worst crashes. The damage wasn't limited to Bitcoin. Ethereum, the second largest cryptocurrency, got absolutely destroyed. It crashed 34.5% in a single week, falling to $1,850. That was its lowest level since mid-2024, and a 57% decline from its August 2025 peak, near $4,900. The ETH to BTC ratio hit a 3-year low, meaning Ethereum was massively underperforming even the cratering Bitcoin. Altcoins across the board were devastated. Solana, BNB, Litecoin, XRP, they all broke long-term support levels and plunged into deeply oversold territory. The liquidation numbers were staggering. $2.6 billion in leveraged positions were wiped out in a single 24-hour period. Most of those were long positions, meaning traders who were betting prices would go up. For Ethereum alone, $466 million in liquidations hit on February 5th. 382 million of those were longs. The Crypto Fear and Greed Index, which measures market sentiment on a scale from 0 to 100, dropped to somewhere between 5 and 11. That's deep into extreme fear territory. The lowest reading since the Terra Luna collapse in 2022. Bitcoin's Relative Strength Index, or RSI, fell near 9. For context, anything below 30 is considered oversold. 9 is panic. Meanwhile, US spot Bitcoin ETFs posted $434 million in net outflows on February 5th alone. BlackRock's IBIT led the exodus with $175 million in outflows. Fidelity's FBTC lost $109 million. Grayscale's GBTC shed $75 million. 6 of the 12 Bitcoin ETFs posted negative flows that day. Not a single one saw inflows. Let's talk about the people behind these numbers. It's easy to look at charts and see lines going down, but behind every liquidation, every margin call, every forced sell, there's a person. And a lot of people got hurt. Some investors saw their entire fortunes vanish overnight. Not just profits, fortunes. People who had bought Bitcoin near the top, convinced it was going to 200,000. People who had leveraged their positions, borrowing money to buy more. When the crash hit, they didn't just lose their investment. They ended up owing money. Worse off than broke. The Daily Mail reported stories of crypto investors watching their life savings evaporate in hours. Reddit threads filled with people sharing losses. Some had taken out home equity loans to buy Bitcoin. Some had put their retirement savings in. The math was brutal. If you bought one Bitcoin at 126,000 and it dropped to 60,000, you lost $66,000 on a single coin. But here's the other side. Not everyone panicked. Data from at least one major platform showed that a majority of trading volume during the crash actually came from buyers. Long-term holders saw the crash as a buying opportunity. Clients who had set target price orders bought 4 times their average amount. Over 24% of recurring buy orders were increased to take advantage of lower prices. That's the paradox of a crash. It's simultaneously the worst possible moment, and for those with cash and conviction, potentially the best one. Now, one of the most debated questions in crypto came roaring back during this crash. Is the 4-year cycle dead? For over a decade, Bitcoin followed a remarkably consistent pattern tied to its halving events. Every 4 years, the reward that miners receive for processing transactions gets cut in half. This reduces the rate of new Bitcoin supply entering the market. Historically, each halving was followed by a massive bull run. 2012 halving led to the 2013 surge. 2016 halving led to the 2017 boom. 2020 halving led to the 2021 all-time highs. The April 2024 halving was supposed to follow the same playbook, and for a while, it seemed like it would. Bitcoin did reach new all-time highs, but something was different this time. Bitcoin hit 73,000 in March 2020, before the halving even happened. That had never occurred before, the price peaking before the supply cut. Then it went higher in late 2025, topping out at 126,000. But then it crashed, hard. By early 2026, Bitcoin was trading more than 50% below its peak. Multiple analysts are now declaring the 4-year cycle officially dead. And there's a compelling reason why. The market has fundamentally changed. In previous cycles, Bitcoin was driven primarily by retail speculation and the supply dynamics of the halving. But now, institutional investors dominate ETFs, corporations, traditional finance. These players don't trade based on halving schedules. They trade based on liquidity conditions, interest rates, regulation, and geopolitics. The macro environment matters more than the mining reward now. Bitwise's chief investment officer, Matt Hoogan, cited the 4-year cycle as a framework for understanding the losses, arguing that corrections are a normal part of the pattern. But other analysts counter that the cycle, if it ever truly existed in a predictive sense, has been fundamentally disrupted by institutional adoption. The old playbook doesn't apply to this new market. Whether the cycle is dead or just evolving, one thing is clear. The forces driving Bitcoin's price are more complex and interconnected with traditional finance than ever before. Let's put this crash in historical context, because Bitcoin has crashed before, many times. In 2011, Bitcoin dropped from $32 to $2, a 94% decline. People said it was dead. In 2014, after the Mt. Gox exchange collapse, Bitcoin fell from over $1,000 to under $200, an 85% decline. People said it was dead. In 2018, after the ICO bubble burst, Bitcoin dropped from nearly 20,000 to about 3,200, an 84% crash. People said it was dead. In 2022, the Terra Luna collapse triggered a cascade that took down Celsius, Three Arrows Capital, and eventually FTX. Bitcoin fell from 69,000 to about 15,700, a 77% decline. People said it was dead. Every single time, Bitcoin recovered and eventually set new all-time highs. But here's what makes the 2026 crash different from 2022 and the earlier disasters. In those previous crashes, the collapse was caused by internal problems within crypto itself. Exchanges going bankrupt, stablecoins imploding, Ponzi schemes unraveling, fraud being exposed. This time, no major crypto project collapsed. No stablecoin failed. No exchange went bankrupt. The underlying technology didn't break. The crash was driven by external macroeconomic forces and leveraged positions in traditional financial instruments. Trade wars, Federal Reserve policy, hedge fund blow-ups using ETF options, yen carry trades. In a strange way, that might actually be good news for crypto's long-term future. It means the ecosystem itself is more resilient than before. The problem wasn't crypto. The problem was how the traditional financial system interacted with crypto. The leverage, the derivatives, the complex bets that amplified every move. But it's also a warning. Bitcoin is no longer an independent asset living in its own world. It's deeply connected to global finance. When Wall Street sneezes, Bitcoin catches pneumonia. The promise of Bitcoin as uncorrelated, as a hedge, as digital gold, that narrative took a serious hit in February 2026. So where do we go from here? As of mid-February 2026, Bitcoin is showing signs of stabilization in the $65,000 to $70,000 range. Forced liquidations are shrinking, which analysts say is a necessary precondition for a sustainable recovery. The market has moved from panic to cautious observation. Analyst predictions for the rest of 2026 are all over the map. Standard Chartered sees Bitcoin at 150,000, though they revised that down from 300,000. Bernstein also targets 150,000 by year-end. The optimists, like Fundstrat, think it could hit 200 to 250,000. On the bearish side, some models suggest Bitcoin could still drop to 50,000 before recovering. The probability models are interesting. According to aggregated analyst estimates, there's roughly a 79% chance Bitcoin reaches $100,000 again in 2026. A 41% chance it exceeds its previous all-time high of 130,000. And an 80% probability it touches 75,000 or lower at some point during the year. In other words, more volatility ahead, in both directions. The key factors that will determine which way this goes are the Federal Reserve's actual policy under Kevin Warsh. If he tightens aggressively, risk assets, including crypto, could face sustained pressure. If the economy weakens enough to force rate cuts, that could provide the fuel for a recovery rally. The trajectory of ETF flows matters enormously. After the February exodus, early signs of renewed inflows would signal institutional confidence returning, and regulatory developments, including the status of the strategic Bitcoin reserve, could shift sentiment dramatically. If you're watching this and you own Bitcoin, or you're thinking about it, here are some things worth sitting with. 1. The crash wasn't caused by something breaking inside crypto. That's different from 2022. The infrastructure held. The blockchain kept running. The ETFs functioned, even when they were the vehicle for massive selling. This is a sign that the underlying system is more mature than it was. 2. Leverage kills. This crash, like almost every financial crash in history, was amplified by leverage. Borrowed money, options, carry trades, complex positions that look brilliant on the way up and turn catastrophic on the way down. Whether it's long-term capital management in 1998, the mortgage crisis in 2008, or Hong Kong hedge funds in 2026, the story is always the same. Too much leverage, not enough margin for error. 3. Promises from politicians are not investment theses. The idea that a crypto-friendly president would provide a permanent floor for Bitcoin prices turned out to be wrong. Markets are bigger than any one administration. Macro forces don't care about campaign promises. 4. The institutions that were supposed to stabilize Bitcoin actually made it more volatile. ETF-driven demand created faster, larger price swings in both directions. When institutions buy, they buy big. When they sell bigger. That's not stabilization, that's amplification. 5. Nobody knows what happens next. The range of predictions for Bitcoin, from 50,000 to 250,000, tells you that even the experts are guessing. Anyone who tells you they know with certainty where Bitcoin is going is either lying or selling something. And 6. Bitcoin has survived every crash it has ever faced. Every single one. That doesn't guarantee it will survive the next one. Past performance doesn't predict future results. But the track record is there. So is this the end of Bitcoin? Probably not. Bitcoin has been declared dead over 470 times by mainstream publications. It's still here. But is this a wake-up call? Absolutely. The dream of Bitcoin as an uncorrelated asset, immune to the forces that move traditional markets, suffered a severe blow in February 2026. Bitcoin is now entangled with Wall Street in ways that can't be undone. The itoios that brought billions in legitimacy also brought Wall Street's leverage, Wall Street's risk management failures, and Wall Street's capacity for spectacular blow-ups. The next chapter of Bitcoin's story won't be written by cypherpunks and early adopters. It'll be written by Federal Reserve policy, institutional fund flows, geopolitical events, and the complex financial instruments that now wrap around the underlying asset. Bitcoin entered 2024 as a maverick. It entered 2025 as an institution, and it entered 2026 humbled. The question isn't whether Bitcoin will recover. It probably will. The question is what Bitcoin becomes when it does. Because the asset that comes out the other side of this crash won't be the same one that went in. And that might be the